Welcome back to UK Property Info. The news coming out of the property market this week has left many homeowners, investors, and prospective buyers feeling deeply unsettled. Confidence in the UK property market has taken another significant hit, and the latest figures paint a picture that demands our immediate attention and careful analysis. Today I'm going to walk you through exactly what is happening, why confidence has plummeted so dramatically, and what this seismic shift means for anyone with a stake in UK property. Whether you own a home, you are trying to buy one, or you have investment properties in your portfolio, the developments we are witnessing right now will affect you directly. Let me start by putting some concrete numbers on what we are seeing. The latest consumer confidence surveys show that sentiment around property purchases has fallen to levels we have not witnessed since the aftermath of the 2008 financial crisis. The RX Housing Market Survey recorded a net balance of minus 47% for new buyer inquiries, meaning significantly more. Estate agents are reporting falling demand than rising demand. This is not a marginal decline or a minor blip on the radar. This represents a fundamental shift in how people feel about committing to what is typically the largest financial decision of their lives. When confidence collapses like this, it creates ripple effects that touch every corner of the property ecosystem. The question everyone keeps asking me is why this is happening now. After all, we have been dealing with high interest rates for over a year. The cost of living crisis is not new. So what has triggered this fresh wave of pessimism that is sweeping through the market? The answer lies in a combination of factors that have converged at precisely the wrong moment. Firstly, there is growing recognition that interest rates are not coming down as quickly as many had hoped. Earlier this year, there was widespread optimism that the Bank of England would begin cutting rates by summer. That optimism has evaporated. Inflation has proven stickier than anticipated, and the bank has made clear that rates will remain elevated for longer. For mortgage holders coming off fixed-rate deals, this means facing significantly higher monthly payments with no relief in sight. The second factor driving this confidence collapse is the dawning realization that property prices are not going to bounce back quickly. Many homeowners have been holding on to the belief that any price declines are temporary and that values will recover within a year or two. The latest data suggests otherwise. Property prices in many regions have now been falling for 18 consecutive months. The average home is worth approximately 15% less than it was at the peak in late 2022, and credible forecasters are now suggesting that prices could fall further before stabilising. This extended period of decline is psychologically damaging for homeowners who have watched their equity shrink month after month with no sign of recovery. There is a third element that we need to discuss, and it relates to employment and job security. While unemployment figures remain relatively low by historical standards, the nature of the job market has shifted in concerning ways. Major employers across multiple sectors have announced redundancies. Tech companies, financial services firms, and even traditionally stable sectors like professional services are trimming their workforces. When people feel uncertain about their jobs, they become extremely reluctant to take on large financial commitments. A mortgage that seemed manageable when you felt secure in your career suddenly looks terrifying when redundancy rumours are circulating in your office. This creeping job insecurity is having a chilling effect on buyer confidence that shows up clearly in the data. The impact of this confidence crisis is visible in transaction volumes. The number of homes changing hands has fallen dramatically compared to the same period last year. Estate agents are reporting that properties which would have attracted multiple viewers and competitive offers just 2 years ago are now sitting on the market for months with barely any interest. Open house events that used to draw queues of eager buyers are now sparsely attended affairs. This collapse in activity creates a negative feedback loop. Sellers see properties languishing on the market and become more pessimistic about their chances of achieving their asking price. Buyers see a market in decline and decide to wait on the sidelines, hoping for further price drops. The result is a market that has seized up, with neither side willing to make the first move. For those of you who own property and are watching this unfold with growing concern, I want to provide some context that might be helpful. Property markets move in cycles, and periods of declining confidence are a normal part of those cycles. What we are experiencing now, while uncomfortable, is not unprecedented. We saw similar confidence collapses in 2008, in the early 1990s, and in the mid-1970s. In each case, the market eventually stabilised and recovered, Although the timelines varied considerably, the key question is not whether confidence will eventually return, because it will, but rather how long this period of pessimism will last and how far prices will fall before the bottom is reached. The rental market deserves special attention in this analysis because it tells us something important about underlying demand for housing. While the sales market has ground to a near standstill, the rental sector remains extremely competitive. Rents continue to climb in most areas, and tenants are competing fiercely for available properties. This tells us that the fundamental demand for housing has not disappeared. People still need somewhere to live. What has changed is their ability and willingness to purchase, rather than rent. This distinction matters because it suggests the current crisis is primarily about affordability and confidence, rather than a structural collapse in housing demand. When conditions improve, there is a substantial pool of potential buyers waiting to enter the market. Regional variations in this confidence crisis are worth examining in detail. London and the South East, which led the price growth during the boom years, are now experiencing the sharpest declines in both prices and confidence. Properties in outer London boroughs that once sold within weeks are now taking 6 months or more to find buyers. The premium that people were willing to pay for proximity to the capital has evaporated as remote working has become permanent for many professionals. Meanwhile, more affordable regions in the Midlands and the North are proving somewhat more resilient. Prices have fallen less dramatically, and transaction volumes have held up better. This divergence reflects the different affordability dynamics across the country and suggests that the recovery, when it comes, may also be uneven. I want to address something that I know many of you are thinking about. Is this the moment to buy? With prices down 15% and sellers increasingly desperate, surely there must be opportunities for those brave enough to act while others hesitate. This is a nuanced question that deserves a thoughtful answer. Yes, there are undoubtedly opportunities in the current market. Sellers who need to move are accepting offers they would have rejected outright 2 years ago. Negotiating power has shifted decisively to buyers, and those with secure finances and a long-term perspective can potentially secure excellent deals. However, timing the bottom of any market is extraordinarily difficult. Prices could fall another 10% before stabilising. Buying now means accepting that your property might be worth less in 12 months than you paid for it. For existing homeowners who are not planning to move, the most important thing is to avoid panic. Paper losses only become real losses when you sell. If you bought your home to live in, rather than as a short-term investment, the current market conditions are uncomfortable, but not catastrophic. Focus on ensuring you can meet your mortgage payments, particularly if you are approaching the end of a fixed-rate deal. Speak to your lender early if you anticipate difficulties. Most lenders have hardship programs and would rather work with you than pursue repossession. The worst thing you can do is bury your head in the sand and hope problems resolve themselves. Proactive engagement with your financial situation is essential during periods of market stress. Landlords and property investors face their own set of challenges in this environment. Rising mortgage costs have squeezed margins on rental properties, and some investors are finding that their properties no longer generate positive cash flow. This is driving some landlords to exit the market entirely, selling properties and reinvesting elsewhere. For those who remain, the strong rental market provides some compensation for falling capital values. Yields have actually improved in many areas as rents have risen, while purchase prices have fallen. The calculation for investors now is whether to prioritise rental income over capital appreciation, a significant shift from the mindset that dominated the market during the boom years. The government response to this confidence crisis has been notably muted. There have been no dramatic interventions of the kind we saw during the pandemic, when stamp duty holidays and other measures were deployed to support the market. This restraint is partly philosophical. The current administration appears to believe that the price correction is a necessary adjustment after years of unsustainable growth. It is also partly practical. With public finances stretched and inflation still elevated, there is limited appetite for measures that might be seen as propping up house prices at the expense of first-time buyers hoping for more affordable homes. This means that market participants should not expect cavalry to arrive. The market will find its own level, and that process may take longer than many would like. Looking at the mortgage market provides additional insight into the dynamics at play. Lenders have become significantly more cautious in their underwriting standards. Loan-to-value ratios have tightened, and borrowers face more rigorous affordability assessments than they did during the boom years. Some lenders have withdrawn entirely from certain segments of the market, reducing choice and competition. Mortgage rates, while off their peak from last autumn, remain well above the levels that borrowers became accustomed to during the years of ultra-low interest rates. A typical 5-year fixed-rate mortgage now carries an interest rate of around 5%, compared to below 2% at the market peak. This dramatic increase in borrowing costs has effectively reduced purchasing power by 30% or more for many buyers. The new build market offers an interesting window into developer sentiment and expectations. Major house builders have significantly scaled back their construction programs in response to falling demand. Land purchases have slowed as developers question the viability of projects at current price levels. Some developments that were approved during the boom are now on indefinite hold. This reduction in new supply will eventually have consequences for the market. If construction falls too far below household formation rates, we could emerge from this downturn into a market that quickly tightens again due to insufficient supply. The seeds of the next boom are often planted during the depths of the previous bust, and that pattern may be repeating itself now. Consumer psychology plays a crucial role in property market dynamics, and understanding it helps explain why confidence matters so much. Housing decisions are not purely rational financial calculations. They are deeply emotional choices intertwined with our sense of security, status, and identity. When confidence is high, people stretch to afford properties because they believe values will continue rising, and they will be rewarded for their optimism. When confidence is low, even buyers who could comfortably afford to purchase hold back because they fear making a mistake at the wrong time. This psychological dimension means that confidence can become self-fulfilling. Pessimism leads to inaction, which leads to price falls, which validates the pessimism, creating a cycle that is difficult to break. I want to share some perspective from estate agents and property professionals who are working at the coalface of this market every day. The consistent message I am hearing is that realistic pricing has never been more important. Properties that are priced in line with current market conditions are still selling, although more slowly than in previous years. Properties that are priced based on what owners think their homes should be worth rather than what buyers are willing to pay are languishing indefinitely. The gap between seller expectations and buyer reality remains one of the biggest obstacles to market function. Sellers who adjust their expectations quickly are completing transactions. Those who refuse to accept the new reality are simply watching their properties gather dust on listing websites. For anyone trying to navigate this market, whether buying, selling, or holding, I would offer the following observations. First, extend your time horizons. Property should always be viewed as a long-term asset, but this is especially true during periods of market stress. Making decisions based on short-term price movements is a recipe for regret. Second, focus on fundamentals. Location, transport links, local amenities, and property condition matter more during downturns because buyers become pickier when they have more choice. Third, maintain financial flexibility. Having reserves to weather unexpected challenges is valuable insurance during uncertain times. Fourth, seek quality advice. This is not the market for amateurs or those unwilling to do proper due diligence. The question of when confidence will return is impossible to answer with precision, but we can identify the factors that will signal a turn. Watch for stabilization in interest rate expectations. When markets begin pricing in rate cuts with conviction, confidence will start to rebuild. Monitor employment data carefully. Sustained strength in the job market would provide the foundation for renewed buyer activity. Pay attention to transaction volumes as an early indicator. Rising sales activity typically precedes price recovery as buyers begin to emerge from the sidelines. And observe mortgage lending data. When lenders begin competing more aggressively for business, it signals their belief that conditions are improving. In conclusion, the UK property market is undeniably going through a difficult period. Confidence has plummeted, prices are falling, and transaction volumes have collapsed. But markets are cyclical, and the conditions we are experiencing today will not persist forever. For those with the financial resilience to weather this storm and the patience to wait for conditions to improve, there may be opportunities that were not available during the boom years. For those who are stretched or uncertain, caution is warranted. The next 12 to 18 months will likely see continued challenges before meaningful recovery begins. Stay informed, stay realistic, and remember that property remains a long-term asset class that has weathered many storms before this one. Thank you for watching this analysis from UK Property Info. If you found this breakdown valuable, please subscribe to the channel for regular updates on the UK property market. Hit the notification bell so you never miss a new video. Share this with friends, family, and colleagues who own property or are thinking about buying. Leave your comments below, telling me about the conditions you are seeing in your local area. Your observations help build a complete picture of what is happening across the country. Until next time, this is UK Property Info, helping you make sense of the property market one video at a time.